Good morning, everyone. It's a pleasure to be back for yet another set of discussions on where we are and where we think we are going. I'd like to touch on three themes, really, this morning. First is three macro themes, if you want. One is this growth rebalancing that's been going on for over a year now between developed and emerging markets. Acceleration in some developed markets, significant slowdown in emerging markets. That's a new picture that we have in front of us that contrasts quite markedly with what used to prevail after 2009. The second is obviously we are in a rather extraordinary configuration as far as developed markets are concerned, with oil prices having fallen by over 50% in 6 months or so. If I had a year ago in this room made the prediction that everything was going to get better and that growth was going to accelerate everywhere, because oil prices are about to fall, I think you would have called the emergency ward and sort of said, this guy is really losing his marbles. That's exactly what happened. I did not lose my marbles. The oil prices actually collapsed in the second half of last year, and so did a number of other commodity prices, really boosting the purchasing power of consumers in developed markets. This is the exact equivalent of a massive tax cut on oil importing countries' consumers. And third theme I'd like to touch on is obviously, and perhaps spend a bit more time on that third one, is the diverging trends in monetary policies and the effects on the yield curve and on long-term bond yields, especially looking at QE in the Eurozone and what that's likely to produce, what we can say about it so far, and what we expect in the next couple of years. So, first theme is diverging trends between emerging markets and developed economies. These are import indices in volume reflecting the world as a whole, so that's world trade, the Eurozone, emerging markets, that goes beyond the BRICS, that's the 20 or so largest emerging markets, and the US. And I think you can see, first of all, obviously, that after 2009, the major contribution that was brought about by the emerging markets in pulling our economies out of the trough and resurrecting growth, really, that I think via massive fiscal stimulus in many countries. And at this point in time, what's striking is that world trade is actually net pretty flat. If you look at the rate of growth in world trade last year, it was slightly less than 3%, between 2.5% and 3% in volume. That's less than half the long-term average in terms of world trade growth that we've observed in the last 25 years. So this is, and this of course helps to understand also what happened on the commodity prices front. Less demand from emerging markets, and but it also explains that whilst we were having this rebalancing with growth accelerating in the US, the UK, and a few other developed economies, really world trade itself did not, net, as I said, reflect this acceleration. And we do expect this gap between the two parts of the world economy to continue to prevail in 2015 and 2016 and over. As far as emerging markets is concerned, we'll speak about China in just a minute. It's the combination of cyclical and structural factors that's been affecting those economies. And therefore, we think it's not just a a temporary phenomenon. It's something that will take quite a few years to be addressed. Let's start with developed economies and just a couple of words about the US. I think what is really fundamentally different between the US economy and the Eurozone economy is the stage reached by those two regions in terms of the deleveraging process after the 2008 shock, the beginning of the great financial crisis. The speed at which the US economy was able to deleverage, especially the private sector, is, I think, strikingly different from what has been observed in the meanwhile in the Eurozone, as can be reflected here. This is purely historical data. There's no forecast here. This is just what we have observed in the past few years. And as you can see, the deleveraging in the US is really was quite broad-based between the domestic financial sector, which is another way to call the banks, and the consumers, and the non-financial business, which is basically the corporate sector. And especially as far as consumers are concerned, of course, you could say quite rightly that there are important differences in the regulatory environment for US consumers and European consumers in terms of especially the ability to default on their mortgage and on their credit cards, but especially on their mortgage. In the US, it is clearly much easier, easier might be a strong word, but it is less difficult and less risky to default on one's mortgage than it is in Europe, and particularly in continental Europe. Basically, by transferring the property back to the bank, you get rid of your debt, and you are not liable for any particular penal suit as you would be in Europe. It's what they used to call the jingle mail, where you put the keys in an envelope, put it in the mail, send it to the bank, and it becomes the bank's problem. Now, of course, and that was widely spread at the beginning of the crisis in 2009 and 10, when we had this massive correction in the market, and many homeowners were underwater, so to say. Now, you could say, well, yes, fine, so it's no longer the consumer's problem in that sense. You transfer the debt back to the bank, but it's the bank's problem, right? So it's somebody's problem still. So there's still debt in the system. But then if you look at the number of bank failures that were recorded early on in the US and compare it with Europe, you see that, again, there's been a very striking difference. A number of banks, especially regional banks, that were heavily specialized in housing and mortgages, went belly up early on. And then, of course, at the end of the day, that means that the debt overall is written off. I mean, there is... so the casualties are high initially, but at the same time, the net result is that you end up with a private sector that has deleveraged much more rapidly. We, in Europe, and especially in the Eurozone, are very early on in that stage. What happened in Europe is that we had a very different policy reaction to the crisis, with both the public sector and the private sector starting to deleverage simultaneously. That was very, very clear across the Eurozone. Unlike in the US, where the public sector held off, and gave the opportunity to the private sector to start deleveraging first, and then came in to start following the same process, but only afterwards. This sharp contrast explains also why Europe has been stuck in quasi-recession, in fact, registering two recessions in a row, the deepest recession and then the longest recession, a double dip, really. And clearly the other characteristic of the US strategy, if I can say, after the beginning of the crisis was this very fast and very aggressive response by the Federal Reserve in terms of trying to provide a floor under the housing market and really helping the market to bounce back after a sharp and, should I add, welcome correction. We had very much the same kind of development in the UK, especially with QE1 after 2009. That was a very effective response to maintain a certain level of inflation, which I think is really another big difference with the Eurozone, and indeed help the market find a floor and gradually recover, creating a new wealth effect that fed to the consumers. Now, and the third interesting development was in the last couple of 5 years, let's say, is that a number of manufacturing companies brought their production capacity back in the US. This onshoring development is another very striking difference. One of the major explanations, there were two key explanations for this rather unexpected development. One was the very competitive cost of energy in the US, thanks to shale gas and other developments that you're familiar with and that we'll probably talk about later on. And, excuse me, and also very attractive tax and fiscal regimes offered to those who would repatriate their capacity, their production capacity to the U.S. after the beginning of the crisis. That again was clearly very favorable. Now, net, we think that the U.S. is going to grow about 3% this year. I know that the most recent monthly data has been somewhat disappointing, suggesting that the economy is, you know, especially lately, has not really performed as strongly as was expected. American people are sometimes funny. They did this for the second year in a row. They explained the weak performance of the U.S. economy at the beginning of the year by the cold winter. This is something that's new. In the past couple of years, winters have become cold in the U.S., especially in the Northeast, which is really a new and interesting development. No, we hadn't thought of that. And so that explains why Q1 was same last year. Exactly, you take the press last year, same explanation, cold winter, unusually cold. And same again this year. I would expect next year we will have another cold. I mean, it's a fair prediction to say that the winter next year in the U.S. is likely to be cold, especially in the Northeast. So, but anyway, so that explains that we had a slow start, but I think we are still very comfortable with a forecast of about 3% growth for GDP this year. And of course, the question now is, how do we get down the mountain? How is the Fed likely to normalize? Normalize is a very ambiguous word in the sense that it assumes that the size of the balance sheet of the central banks in the developed markets should go back gradually to where it was or where it would have been if we hadn't had any crisis. You can imagine the size of the if. It's quite difficult to really, imagine where we would be without the crisis. But you can try, and that's what we did on this chart. This chart is the size of this is the balance sheet of the U.S. Federal Reserve in trillions of dollars, We have this dotted line that sort of projects, and this is very hypothetical. I want to stress really, very pathetical, want to project the sort of trend line, the trend growth in the balance sheet had there been no crisis. And that's where we are. And then from there, we can, sort of formulate different assumptions as far as the exit strategy. How do you shrink your balance sheet? And how fast can you do that without creating major havoc or turmoil in world financial markets? This is obviously completely unprecedented. And so, meaning that we don't have any reference, we can't really study how a central bank did it in the past at some point, especially with that kind of magnitude. You can see that, the very unlikely strategy of an aggressive shrinkage, where the bank starts selling the securities some of the securities that it has on its balance sheet, is bringing us to the end of 2016, but of course this is extremely unlikely because it would have extremely dire consequences on financial markets, and there is absolutely no indication today that the Fed has any intention to adopt that strategy. Even the $85 billion reverse QE that we have as a second scenario that would bring us to 2019 or thereabout, seems also quite aggressive. At this point, what we think is the most likely scenario is a passive runoff, meaning that you keep all securities to maturity on your balance sheet. You let them die, in other words, and that leads you to shrink your balance sheet only extremely gradually. If you really take a fully passive runoff, it brings us to about 2023 by the time we are back to normal. And even that is not necessarily certain. The Fed may want at some point to reinvest some of the proceeds and keep the balance sheet at the size that would be higher than this trend line here. So what we can see anyway, and I want to say that ahead of what we're going to say about the Eurozone. Many investors are asking us, with the ECB starting QE, are we not entering dangerous territories here? This is creating a lot of disruptions in the market and all. And our response is yes. That's obviously, again, it's a new experience, and we'll talk about it in a minute. But for now, the biggest uncertainty is in the U.S., not in the Eurozone. In the sense that as long as you have QE in the Eurozone, which is another couple of years, it will remain fairly predictable. What is much less predictable is what happens with interest rates and the balance sheet of the Federal Reserve. We have the first hike in interest rates around September, October. Again, the level of inflation would not justify any hurry on the part of the Fed. And again, they are extremely aware that the temper tantrum that we had in May 2013, when for the first time the Fed signaled that it could change the pace and hike interest rates, and what it did to emerging markets, is a reminder that this execution is going to be extremely difficult to perform. So net-net, I think that what we believe is 3% growth. We're not too concerned about the very recent counter-performance. We think it's sort of finding a longer-term sustainable pace. Interest rates are very, very slow, very gradual increase starting around September, October. And Fed normalization balance sheet, most likely scenario, a passive runoff. So we see the yield curve steepening, indeed, in the US, but this is going to be, again, a very gradual steepening. Now, of course, accidents can happen. But this would be our scenario for now. So that's the first theme. Second theme is oil prices. I'm not going to make any comments about the trend in oil prices because this is something my colleague from Platts is going to cover more knowledgeably than I could. Again, what this is obviously providing is a significant boost to the purchasing power of consumers in developed markets. In that sense, because of the fact that there is hardly any tax wedge in the US, the biggest winners are the US consumers because they get the vast proportion of this cut is passed along directly to them. In Europe, we have a tax wedge, and only part of the decline in oil prices is transferred back to retail consumers. But still, it is a significant boost, which is helping our economies get back on their feet. It is also a big help for those emerging markets that are net oil importers. And that's particularly the case in Asia. This is the slide that we have here in front of us with the trade deficits in most countries, with the exception of Indonesia and Malaysia. Those economies are likely to benefit strongly from lower energy costs. So on that sense, we think that this is really a game changer that's taken place in 2015. One quick word about China. China is experiencing what we would call a structural change. This is not just a cyclical adjustment. This is a change that's taking this economy from an investment-led type of economy to a consumer-led economy. This kind of transition was observed in the past. It took place in Japan in the 70s. It took place in countries like South Korea in the late 70s, early 80s. This is a fairly typical transition in the sort of economic history. But what's never been seen is a transition when an economy, first of all, of that size, but even more importantly, an economy where investment as a share of GDP is so high. 65% investment represents today 65% of GDP in China. At the top, in Japan, in the 70s, it never exceeded 48%. So we are really at a much higher proportion. And so to go down and have consumer consumption really replaced to a certain rebalance, not replace, but rebalance, and have a much more balanced, long-term, sustainable growth model is likely to take many years. The good news is that the Chinese leadership seems to have acknowledged this and recognized that this transition is going to be associated with lower rates of growth. And that's why we're saying slower growth is actually a good thing, because since the beginning of the great financial crisis, credit growth, which supported really the overall GDP growth, has been too fast, has been really excessive and needed to be reined in. But obviously, given, again, the sort of ratios I was mentioning, this kind of transition, again, the execution is likely to be quite difficult. And more immediately, our biggest worry at this point is what's happening in the property sector. We are starting to see a massive correction in house prices and in property prices in China, which is probably welcome in the sense that there was really a bubble there. But in order to project, price trends and see where we are going with this, there is one variable that we would need in the equation, if you want, and that's the size of the inventory overhang. And we do not know. We simply do not know. We know that there is an overhang, that there is excess supply at this point, that it's a significant excess supply, but we don't know by how much. And that is obviously a big worry. It reminds me, and the comparison is a bit daring because obviously it's so different, but it reminds me a little bit of the Spain 2006 situation. We know that there is a bubble. We know prices are too high and growing too fast. We know that there are ghost towns being created and built everywhere, but we don't know exactly, by how much and the proportions, the magnitudes, until we get it, right in the face, and that's Spain 2009. So I'm not saying we're going to see a repeat. But this is certainly a big risk that needs to be kept up there for now. Europe, and especially the Eurozone. As I said, clearly we are in a very interesting configuration at this point where we have a lower oil and lower energy prices. We have a weaker currency that's really helping our economies. And we have, finally, an expansive and aggressive monetary policy now being launched by the central bank. The effects on the euro was obviously quite immediate, and we are also looking at real wages getting a bit of a boost. This is particularly the case in Germany, where this year, the real wages are likely to grow by about 2%. That's in real terms, nevertheless, really, which means that Germany's consumers are likely to be again, or not again, but maybe for the first time after many years, a major driver of growth in Europe as a whole. So I'd like to now talk about the monetary policies and what it's likely to do on interest rates, because I think for your industry that has some clear implications. I think you need, looking at this QE program that was announced in March, was pre-announced in January and announced in March. There are several ways to, there's several angles one needs to take to look at this program. The first is credibility of the program. The second is execution of the program. And the third is the results, the likely impact of that program. I think as far as the first view, credibility, I think it is fair to say that the ECB has succeeded in impressing the markets positively. Its credibility has improved, and this program of 60 billion euros per month, open-ended program. This is, in our opinion, a very important commitment. The fact that the program is not to stop in September 2016. It will be reviewed then, but there is no commitment that it may stop. If it needs to be continued, ECB is very clear, we will continue as long as it takes. And the market reaction, if you look at financial markets, equity markets in particular, was very supportive. So in terms of credibility, we can tick that one off. Yeah, it's off to a good start. Now, the second question is execution. Here, first of all, the ECB did something which we think is was fairly smart and contrast with what was done in the UK and in the US, which is about 6 months, excuse me, about 6 months before really implementing the QE program, it announced that deposit rates at the central bank were now going to be negative by 0.20%. This really contrasts. I mean, we've never had deposit rates in negative territories, neither in the US nor in the UK. We had a few cases of negative deposit rates in the past. Switzerland, for instance, when they were targeting a specific FX rate for the Swissy, and also related to an FX target in Denmark. You know, the Danish kroner is pegged on the euro, and at some point the Danish central bank had negative deposit rates. But we've never had a large central bank having negative deposit rates, and what it did is really push the short end of the curve into negative territories even before we started the actual QE program. And so that's the first observation, and it really sort of pulls the yield curve in a very specific shape. Then there is a second aspect, which is that we need to ask the question, who is likely to sell to the European Central Bank? The bank wants to expand its balance sheet by 50% between March and September 2016. 50 billion of govies and 10 billion of ABS and other structured products per month between now and then. So you have to, and there are specific capital keys where, that describe where they can buy how much. And so we need to, the question we've asked ourselves is really, all right, so that's aggressive, but who is likely to sell to the ECB? Who owns the government debt at this point in time? And of course, the largest segments are the banks and insurance companies. And you know only too well that the paradox in the current situation is that while we have the ECB coming out and saying, sell to me, we have the regulators, on the other hand, saying, keep your govies, because in terms of capital cost, that's obviously what's going to cost you the least. And so there are very contrasting messages coming from the regulatory side and from the monetary side at the same time. So we think that the propensity to sell of banks and insurance companies, we sold too, obviously is also basically broadcasting the same message. Their propensity to sell is likely to be rather low. So if you take those out, and obviously they represent a very large fraction of the total of the holders of government debt, then the next category of investors holding government debt in the Eurozone are non-resident investors, rest of the world. They have quite a large proportion. The non-domestic, non-Euro investors own exactly 30% of the actual stock of government debt in the Eurozone, of the 7.4 trillion euros of government debt that's standing out there at this point in time, 30%. And obviously, they would have a strong incentive to sell. Their propensity to sell should be quite high. At this point in time, if you look at the distribution of negative yields in Eurozone assets, it's a strong incentive to really shift to other markets. But what's interesting here is that the distribution in terms of those non-domestic, non-Euro, non-domestic investors varies between the core and the periphery. Non-Eurozone investors own 39% of the core government debt. 39, let's say 40% of the core government debt, when in fact they only own about 14% of the periphery. that's easy to understand why. I mean, if you look at, remember the past few years' developments, etc., the core was obviously always viewed as a safe asset when periphery, especially in around 2010, 11, 12, was much more risky. But what that means is that net-net, for the European Central Bank to be able to really attract a sufficient amount of sellers, will have to accept to pay significantly higher prices, is really the bottom line. And they have, with this negative deposit rate, and that's where I was going a minute ago with my little thing about the deposit rates. They have put a sort of, a lower or a maximum price that they're ready to pay. At this point, we will not go below negative 0.20% yield as we buy those securities. We think that there is a fair possibility that the bank, not today, but in a few quarters, may have to further lower the deposit rate, further into negative territories, so to give itself more space in terms of acquiring government securities, and especially from non-domestic investors in the periphery, or holding debt in the periphery. So that's a very, again, that's a very complicated and very tricky exercise that they will have to perform. But the message here is, on the execution side, they should buy, again, understand me well, I'm not saying they will not find buyers, they will find buyers. As we know, in markets, it's always a question of price. At a certain price, you will always find a buyer and a seller, or in this case, a seller. The question is really what price and what that's going to do to the long-term yield curve, which is likely to end up being extremely flat with, in our opinion, the Bund yields 10 years at about 0.2% on average in both 2015 and 2016. Extremely low long-term rates, which especially for some insurance companies, is obviously not exactly great news. And third is the effects. What's that going to do to the Eurozone? Economy and inflation. And I'll finish with this. This is just a quick in-passing message. This is real GDP per capita, 1998 equals 1, so it's rebased. And well, first of all, I want to obviously show the shock and the magnitude of the decline since the beginning of the crisis. But I also want to spell out the fact that Italy has had a more severe shock than Greece. Real GDP per capita since the beginning of the crisis dropped more in Italy than it did in Greece. In the past 3.5 years, Italy has not grown at all, but for 1 quarter. So we have a very large economy in the Eurozone that's still stuck in a no-growth mode. So all the attention is on Greece, and that is obviously understandable. But there are, other economies that have also been severely affected by the crisis. And as I said at the very beginning, the other major headwind remains the high level of leverage that prevails in a number of countries. Which is also why, unlike in the US, what we are seeing today is consumer demand accelerating in many European countries thanks to oil and low inflation. We are seeing exports starting to benefit from the weaker euro. We are seeing housing markets stabilizing and perhaps coming back up in Spain, in Italy, in Portugal, of course in Ireland, but in Ireland it's actually scary because it's really booming again. I mean, the numbers are just staggering. But we're not seeing a genuine recovery in corporate investment at all. at this point in time. And that's obviously a very worrying situation. So I think that it is probably fair to say, and this also unfortunately looks like a cliche, but it's fair to say that the worst is probably behind us. We have turned a corner. The drop in energy prices, the very aggressive response by the European Central Bank are game changers. They will bring our economies back in a low growth mode, but still it's positive growth again, which is good. Probably insufficient to really affect meaningfully the level of unemployment. We see unemployment coming down in many economies, but we're still looking at high levels. The only big exception in all this is Germany. Germany today is in full employment. Today. We are approaching 4%. This is a level where you can talk about full employment. This economy is likely to go at about 2%, German economy this year, which is again slightly higher than potential growth. So there is still a sharp contrast between the German performance and the rest of the Eurozone, which is still slowly accelerating, shall we say, but with big structural problems still very present. So we've turned a corner, but we're not out of the woods. Thank you very much for your attention, and I'll turn now to my colleague from Platts. Thank you.